Recording in progress. Good morning and welcome to Broker Briefing, Australia's premier digital platform for brokers and investors, live streaming video presentations from ASX listed companies. I'm Jane Morgan and thank you for joining me today. Today we are joined by 6 companies: Capral Limited, Aeon Metals, BPH Energy, Lithium, Infiniti Lithium, and McArthur Oil Gas. So up first, we have a presentation from Capral Limited with the ticker code CAA, Australia's largest extruder and distributor of aluminium products. To tell us more, we are joined by Managing Director, Tony Dragicevic. Tony, good morning. Oh, you're on mute there, Tony. Oh, I'll just get you to unmute yourself if you can. In the meantime, I'll bring up your presentation.
Right. All right. It's a pleasure to be able to present the Capral business this morning to everybody. So welcome. I'm Tony Dragicevic, the CEO at Capral. First off, I'd like to just give a brief overview of the business so we can turn to the next page. Okay. Capral is the largest supplier of aluminium extrusion and aluminium plate into the Australian market. Our core business is the manufacture and distribution of aluminium extrusion, produced in 6 manufacturing plants, supported by a national sales and distribution network Australian-wide. Aluminium is a strong, lightweight metal and is the preferred material used in lightweight construction applications. Our largest market is residential and commercial building, where we supply fabricators of windows and doors and numerous other building products. We also supply into a wide range of industrial applications, including truck and boat building. Our annual sales revenue exceeds 500 million. Our market share is around 26%. We have 7 local extrusion competitors, with imports making up around 1/3 of the market. We currently employ over 900 people. So we turn to the next page. We'll just go through our highlights of our first half results, which were issued yesterday. A very strong first half, our best result in many, many years. Volumes up 33% on last year to 36,000 tonne. Strong trading EBITDA of 15.7 million, up nearly 10 million on the same period last year. A very strong first half was driven by higher sales demand in all the key markets in which we operate. Improved operating leverage in our manufacturing plants and the benefits of a restructuring that we undertook at our Queensland plant in 2019. We have a very strong balance sheet with net cash 33.8 million at the end of June. Earnings per share for the first half 93 cents, significantly up on the same period last year, and we declared our first interim dividend for some time at 20 cents per share, fully franked. As I said earlier, the market conditions have been buoyant in our key markets of residential building and also the industrial sectors, all assisted, a number of them assisted by government stimulus, particularly in house building. We made a key investment in additional capacity in New South Wales with the acquisition of an extrusion plant from G. James, one of our extrusion competitors, which we acquired in February 2021, February this year. And we spent a lot of effort getting that plant up and running and integrated into Capral's manufacturing network over the past 6 months. Okay, if we move to the next page, I just want to give you a bit of a breakdown on Capral's volume. So our total volume, 85% of it is extrusion, which by and large we manufacture in our 6 extrusion plants nationally. And we also import rolled product, which is sheet and plate aluminium, and that makes about 15% of our total volume. In the middle chart there, the pie chart, you'll see that 59% or roughly 60% of our total volume is sold to large customers directly from our aluminium extrusion plants. The other 40% of our volume is sold through our own distribution business, which is made up of both extrusion and rolled products. The industries that we're exposed to, that's shown on the right-hand pie chart, so 45% of our volume goes into a variety of industrial segments. We're close to 55% of our volume is into residential and commercial construction. So we turn to the next slide. The key influencing market for us is residential commencements, and as you can see, that slide on the right-hand side there shows housing starts in total for the past 10 years. In 2021, residential commencements rose very strongly, forecast to rise very strongly this year, and certainly we saw that in the first half, driven by low interest rates, home builder stimulus, and state government first homeowner incentives. So a very buoyant year in 2021 in the housing market, as you can see by that graph on the right-hand side. Capral's volumes are mainly aligned with detached and low-rise housing, which is the lighter shade, or sorry, the darker shades of green on that graph, which the top part of the graph is multi-res high-rise, which are mainly imported windows, not manufactured in Australia. So you can see there that in 2021, we're looking at our best year in terms of dwelling commencements for the market in which we operate in the past decade. 2022, the forecast is for the market to moderate slightly during 2022, but our customers are telling us that they've got a lot of demand on, which will see them right through to the end of next year at least. So moving to the next slide is just some examples of where Capral's products end up, both from project homes to architectural homes through to a variety of commercial buildings, and mainly windows and doors, but also a wide range of other applications, for example, pool fencing, slat fencing, sunshades, etc. So moving on to the next slide, when we talk about our industrial business, which we've seen, has rebounded very strongly this year. In particular, we've seen very, very strong growth in the marine sector after a relatively slow 2020. The transport sector lifting very strongly on the back of infrastructure. Roading works up 9% in the first half of the year. Manufacturing and general fabrication have also been robust, and have been lifting our share against imports over the past 12 months in the light of import supply chain difficulties and stronger Australian-made sentiment in relation to post-COVID conditions. As I said earlier, imports make up around 1/3 of our market. That share has dropped down to about 5% in the last 12 months, and local extruders have been the beneficiary of that change. Solar rail is a growing market for us. It used to be all imported, but we picked up the largest solar rail distributor in Australia with a contract last year, and we see that trajectory continuing into the years ahead. So moving on to the next slide. There's just some examples of where our industrial products end up from boats to architectural awards through to trailer units on the back of transport trucks. So moving through to the next one, please. Okay, so just quickly on the outlook for the balance of the year, how we see it. We've enjoyed a very strong housing market, as I said earlier, in 2021, and we expect that to continue with housing starts forecasting to grow by 16% this year. That'll underpin the volumes in our manufacturing operations and in our business. We continue to operate as an essential business through COVID restrictions. We have done over the past year and ever since the past 18 months. So we've been fortunate. Even now in Sydney, all of our operations are still operating. And while we do see that the Sydney market construction issue, the restrictions in the Sydney market construction area having an impact, they will be relatively modest in the next 6 months because we do operate nationally. One of our key focuses is growing our own aluminium distribution business, so we've got control over our end customers. The newly acquired plant in New South Wales, we're looking to ramp up to full capacity by the first quarter of next year. We've moved it to 2 shifts currently, with a 3rd shift on by the end of this year. So on the basis of the current market conditions and where we forecast them to be, we're looking at forecasting trading EBITDA of 31 to 33 million for the full year 2021. We run a calendar financial year with a statutory EBITDA of 51 to 53 million. Obviously, the statutory EBITDA under new accounting standards does not include our rental costs, and we believe that the trading EBITDA is a more representative number of our true underlying earnings position. It's a key focus of the board to continuation of fully franked dividends. We have large tax losses in Capral, but we also have access to fully franked dividends for the years ahead. So thank you very much for your attention this morning, and all the best for the rest of the day.
Tony, thanks for the great presentation. I know you just did touch on this just now, but a webinar attendee has asked, so with strong half-year results, are you expecting the next half to have similar sales volumes and revenue figures? And what annual growth percentage are you targeting going forward?
The second half is typically stronger seasonally for us, so we're very confident that all things being equal, that the volumes in the second half of the year will actually be stronger than the first half, which will give us a very strong number in terms of growth for 2021, in the vicinity of around, overall will be around 15 to 20%. Next year that will moderate a little bit, but we're still expecting the housing market and the other markets to remain strong. So our growth projection for 2022, a little bit early at this stage, but we're looking at another 4 to 5% growth in the year ahead.
Wonderful. Well, thank you for joining us again, Tony. We look forward to further updates.
Thank you very much. Bye-bye.
So up next, we have a presentation from Aeon Metals with the ticker code AML. To tell us more about the company's Australian copper cobalt projects, I will now hand you over to Managing Director and CEO, Dr. Fred Hess. Good morning, Fred.
Morning, and thank you.
Let me bring up the presentation.
Okay. Since becoming Managing Director in March of this year, I've essentially embarked on a three-pronged approach to try to reinvigorate investor interest and also to generate shareholder value. Now, first up, what we're trying to do is to continue to explore at Walford Creek. We think Walford Creek is much bigger than what it is already. We're also looking to develop the Walford Creek project. We have a clear and direct pathway to first production in 2025. And thirdly, we're going to determine what our extensive regional tenement package has to offer by way of new discoveries. Next, please. So just the usual cautionary, what it certainly means is for information only, do your own research. But come to the highlights of Aeon and what we have to offer. I think, as I've mentioned, our focus is on the development of the Walford Creek project. And what this really means is developing copper and cobalt. Now, the Walford Creek resource is already very large, well-defined, and the known extent is over 10 kilometres of strike adjacent to the Fish River Fault. This mineral resource remains open, especially along strike to the east and to the west, and importantly, also at depth. Now, we've recently completed high-res geophysical surveys, and these have identified a number of new promising target areas. And we still have extensive gaps in the drilling along strike in the AMI zone. The new flow sheet that we recently developed finally unlocks the substantial in situ value of Walford Creek's polymetallic mineral resource. We have a metal product mix that is ideally matched to emerging investor themes, things like sustainability and renewable energy, battery or electrification metals, and also we offer responsible production from a stable political jurisdiction. Our 50,000 tonnes per annum of copper equivalent production over an existing 14 years of mine life will deliver a competitive operating structure, and it will underpin robust project economics over potentially multiple commodity price cycles. And then there's the significant penetration of solar PV into the overall energy mix, lowering our costs and our carbon footprint. We have a well-developed project development pathway, and this builds on an extensive body of previous study and related test work that has the potential to deliver first production in 2025. As mentioned, we hold an extensive regional tenement package that is highly prospective for copper and for other base metals. And finally, we have the people. I head up an experienced team, and this has recently been augmented with fresh experience and enthusiasm. Next, please. Aeon in a snapshot, our recently completed successful capital raise means that we're cashed up. It also means that we've been able to add new investors to our register, including a number of new institutional investors. And we continue to benefit from the very strong support shown by our major shareholder, OCP Asia. At Aeon, we are building a company that offers a portfolio of battery metal production exposure dominated by copper and cobalt that will also be a major consumer of its very own products through its focus on renewable energy. We're creating a virtuous circle of supply and consumption. Now, Aeon is a vanguard opportunity to satisfy growing investor and community appetite for green mining, mining that leads the way towards greater decarbonisation. Next. We possess a substantial mineral resource already at over 44 million tonnes at approximately 2.5% copper equivalent. The mineralisation extends over almost 10 kilometres adjacent to the Fish River Fault. Now, while the Vardy and Marley zones are extensively drilled, there's enormous potential for additional mineral resources within the 6-kilometre high-grade Amy zone. And this is only sparsely drilled, yet it's also where we have recorded the highest grade intersections encountered to date. Next. We also have a portfolio of metals being produced consistently over a current 14-year projected mine life, with nominal production at approximately 50,000 tonnes per annum of copper equivalent. Next. Our revenue mix is dominated by copper and cobalt. Together, they contribute 70% of the total revenues. But that's not to ignore the fact that zinc, silver and nickel account for a healthy 30%. This diversification leads to a portfolio exposure to commodity price cycles. Our fortunes are not reliant on picking just a single winner over our long mine life. Next. We have strong, consistent cash flows over the entire forecast mine life. At spot prices, these equate to over 1.9 billion of free cash flow. Next. As I mentioned, Walford Creek is ideally located to harness the renewable energy of the sun. It experiences a high year-round solar irradiance with minimal variance between summer and winter. And we also have the benefit of very large flat footprint available adjacent to the mine site where we are able to site a solar grid. Next. We've embraced an aggressive timetable for completing a PFS in Q1 of 2022 and a feasibility study in the second half of 2022. Now, the reason for this is that it is quite soundly based on a substantial body of existing study data and test work results. In fact, many of the elements recently announced in our scoping study are already at feasibility study level. And this is not something you would normally expect, but it does reflect the amount of work that's been conducted over the past 5 years. Our mineral resources are already over 80% measured and indicated. Our mining scheduling and mine design are well advanced. And we have conducted extensive flotation and pressure leaching test work over a number of years. So we feel confident about being able to deliver within these timeframes. Next. Walford Creek has significant further exploration potential. The recently completed high-res magnetic and gravity surveys of the entire tenement package has opened our eyes to many new possibilities. We're currently in the initial stages of testing these, starting with the promising Vardy Deeps target area. Next. Walford Creek sits at the western edge of a large sedimentary basin. Now, the question has to be, is Walford Creek the only deposit sitting on the edge of that basin? Aeon have acquired a substantial tenement package on the northern edge of that basin, And it's our intention over the next 6 to 9 months to undertake further geophysical surveys with a view towards generating potential drill targets. Next. Our extensive tenement package at AWST is prospective for IOCG and also sedimentary copper targets. In 2020, we drilled the Beauchamp target area, and it revealed the presence of an extensive IOCG system and at a relatively shallow depth below surface. Although the system was only weakly mineralised, it demonstrated that we are pretty much in the right suburb and perhaps even the right street, and it's just that we need to continue searching for the right house address. Next. So we believe that Aeon is a compelling investment. We have a portfolio of battery metal exposure headlined by the glamour of copper and cobalt. We have excellent exploration prospectivity at both Walford Creek in our extensive regional tenement packages that are in the process of being further tested. We offer risk minimisation through metal diversification and also the advanced status of our already completed study and test work programs. I think we resonate with investor desires with our strong green mining thematic, and we have very good underlying project fundamentals. So in conclusion, our project timelines mean that we won't have long to wait for the results. Next. So Aeon Metals, we have so much opportunity on offer within a single investment vehicle. Thank you.
Thanks for the presentation, Fred. We've got time just quickly for one question. So when can shareholders expect results from the current drilling?
They should be coming out progressively. There's quite a turnaround time for assays at present, but within the next month or so, we should start reporting on the infill drilling that we've been doing. And I would hope within the next 4 to 6 weeks, the Vardy Deeps target, we can report something on that.
Wonderful. Thank you for joining us, Fred. We look forward to further updates. So next up, we are joined by David Breeze, Executive Chairman and Managing Director of BPH Energy with the ticker code BPH, to tell us more about their oil and gas projects held by investee Advent Energy. I will now hand you over to David.
Thank you.
David, I'll bring up your presentation.
Thanks very much. So thank you for that. BPH has investments in Advent and Cortical, but I'm going to speak today solely on Advent. If we can move to the next slide, please. This slide puts the current gas market issues in Australia in context. As you'll see, very current opening up new sources of gas will be critical to price hikes over the next 2 years. And the East Coast gas shortfall is imminent, and the forecast on the shortfall by the ACCC is dependent upon demand from gas-powered generators decreasing to record lows. So it puts Australia and the East Coast into a precarious position. And what all of these issues in energy mean at the moment, as you see in the final point on that slide, is a network price of 40% from 1 year to the next is almost unheard of, but it's about to happen in the Australian Capital Territory. And this is all to do with the issues that we're having in the national gas market at the moment and national energy market. Next slide, please. So in context, the PEP 11 project is offshore Newcastle. It's 30 kilometres south-southwest. It addresses both the forecast gas shortage and has an objective of net zero emissions and can provide a solution to carbon capture and storage. 1/3 of all of Australia's CO2 emissions come from industrial and other uses in the arc between Newcastle through to Sydney and down to Wollongong. And location, location, location is the key in terms of carbon disposal. In other words, synergies are greatest where the industrial point sources are both near each other and a viable storage site. And that's what we're looking to do with the drilling of the gas project offshore Newcastle. So in New South Wales, 300,000 jobs rely on gas supply. And it's an important factor, or a critical factor, in 84% of the state's industrial gas load and 26,000 businesses. Next slide, please. This slide puts the context of supply and New South Wales' position into context. 98% of New South Wales gas requirements come from other states, and a constrained national gas market will see further gas price rises. But what the AEMO has said is that there will be a 43% reduction in gas supply out of the Victorian offshore gas fields between now and 2025. And that really puts into context the other slides that I've just outlined, or the other points that I've just outlined in the slides to date. You can see how constrained the gas supply pipeline network is into New South Wales, particularly taking that point into account on the 43% reduction. Next slide, please. This is an extract off Cooper Energy's presentation, but it really gives the context in terms of both supply and demand in Australia East Coast. You see there the dotted black line, which is demand going out to 2030. You see the input potentially of Narrabri in the pink colour in that graph of supply. There is a significant shortfall between forecast supply into this market and the demand curve. Next slide, please. What that's doing is it's illustrating the growing influence of LNG pricing on domestic gas prices as that southern supply declines. And what you see there is the importance of the supply constraints into this network in the peak of winter when the demand is highest, but also when you're seeing in the Northern Hemisphere the summer demand. Conversely, of course, in our summer, we have the cold weather in the Northern Hemisphere, and that increases the demand for LNG at critical times. Next slide, please. What this is doing is providing an impetus to price increases over the period between now to 2030. And that illustrates the importance of our project as a gas project offshore Newcastle. Next slide, please. So the importance of that is really recognised by the Australian government and New South Wales government signing an MOU where $2 billion was provided under that MOU to New South Wales with a specific target to bring an additional 70 petajoules a year into the New South Wales market. That's yet to properly occur. And so what you're seeing here in the terms of the environment of power usage is that you had the AEMO having to intervene into the electricity market more than 250 times in 2019-20 compared to just 20 times in the 3 years earlier to that. In other words, Australia is achieving significant and world-leading gains in the input of solar into the supply network, but that's causes an instability. And so we look towards gas-fired power generation as a baseload replacement. Next slide, please. So the offshore PEP 11 project has a prospective recoverable of 5.7 TCF. And we're looking to drill that as the next step in the process, subject to regulatory approvals. Next slide, please. This slide illustrates the importance and the geology that we're dealing with here. And essentially the evolution of hydrocarbon prospectivity of the offshore Sydney Basin back in 1993 was before we had done our seafloor sampling in the offshore area, and that's going to, and I'll go to that in a moment. But what you're really seeing is the model results in all of the late Permian coal measures being in the gas window. And that, of course, is where our baleen drill target for the Sea Blue 1 well is placed. Next slide, please. So the target that we're looking at here is 6,000 acres of amplitude closure, or about 25 square kilometres. In other words, a very substantial drill target, 26 kilometres off the coast. Next slide, please. The slide illustrates the work done post the 1993 study of Grabowski, and it shows the significant gas seepage characteristics in the entirety of the area offshore from Newcastle down through to Sydney. And the importance of that I'll illustrate in the next slide, please, if we can move to that. And that is gas chimneys have been observed to feature, to be associated with gas seepages like pockmarks, and they're illustrated in the offshore Sydney Basin. And active seeps and hydrocarbon migrations are a key indication of ongoing hydrocarbon generation. Where you have this position, Schumacher has shown that 85 or 80% of wells on a global basis come in as discoveries. Next slide, please. The CSIRO did research with us on those seismic attributes in the area of baleen where we're looking to drill. And the key point about this is multiple simultaneous seismic amplitudes that show up gas reservoirs at the target drilling depth that we're looking at just over 2,000 metres. And the same thing here with RMS amplitudes are useful just as instantaneous frequency are to show the presence of gas and or gas condensate. Next slide, please. So in conclusion, we propose to drill a gas exploration well. We propose to explore simultaneously for a carbon storage zone 26 kilometres off the coast and adjacent to the major emission sources of the Newcastle Hunter region. There's no present confirmed geological storage site in New South Wales, and that makes our project extremely important for carbon capture and storage. We will look to provide, the Sea Blue 1 well will provide the opportunity to cost effectively assess that CO2 storage potential. Thank you for listening, and the slide is in fact, up on the ASX now, showing, so you can go through that at your leisure. Thank you.
David, thank you for the great presentation. I've got a quick question to ask. So once the approvals for PEP 11 do come through, will the company have everything in place to start exploration immediately, or will there be further tenders to finalise?
So there are further tenders, and we're going through that process at the moment, but we're going through a planned process as you're seeing with our announcements, where we're making a sequential appointment of contractors to meet the requirements, starting with long lead items and moving through into that process.
Wonderful. Thank you for joining us today, David. We look forward to further updates.
Thanks so much for your time.
Our next two presentations today are from lithium companies. And first up, we have Stephen Biggins, the Managing Director of Core Lithium, with the ticker code CXO. I will now hand you over to Stephen to tell us more about the company's flagship lithium project in the Northern Territory.
Thank you, and I appreciate the opportunity to speak today.
Let me bring up your presentation for you.
Great. Terrific, thank you. With the recent $140 million financing deal, signing binding offtake with one of the world's largest lithium producers, and completion of our definitive feasibility study, Core is construction ready to start producing high quality lithium concentrates out of Northern Australia. We'll be looking to start construction of the project before the end of this year, which will put us right at the front of global new production of lithium, as we look to start construction this year and start production from the project by the end of next year. Next slide, please. And next, thank you, great. So Core Lithium, our Finniss Lithium project is ready to build. We're construction ready, it's fully funded. We have all government approvals we need to start construction of the project, and it's a low risk project with excellent economics. So we are very well placed to become Australia's next lithium producer. It's the most advanced new lithium mining project in Australia. It's positioned only 88 kilometres by sealed road from Darwin Port and less than 45 minutes drive from the suburbs of Darwin, and excellent infrastructure around the project, which is one of its key strengths. The recent equity deal raised up to $140 million, which includes a significant investment from the world's largest lithium producer into the company. So it's a very strong badge of quality for the project, and importantly, it secures funding for us to start building the project. So we are construction ready. The project is fully funded. It's in a low risk tier 1 jurisdiction in Northern Australia, and we have all government approvals in place. So it's ready to build, and we'll start construction of the project before the end of this year and be producing high quality lithium concentrates by the end of next year. And importantly, that's in the context of recent lithium prices heading over $1,000 a tonne. So our timing is absolutely perfect. The economics of the project are excellent, low capital intensity, so only $89 million startup capex to enable us to produce up to close to 200,000 tonnes per annum. So put that in context, $89 million Aussie to be producing revenues of over $200 million per year, and at very high margins, really high margins, because our operating costs are competitive. It's only US $364 for us to produce a tonne of concentrate, and prices going out of Australia at the moment are close to $1,250 US a tonne. So that's a huge margin for us, and our project is ready to build and to hit the market next year in that high pricing environment. And obviously, the project has excellent economics. If I think the $850 US price that we were sort of using in the DFS is now actually quite conservative, considering the latest spot price coming out of Australia is something like 50% higher than that, at around US $1,250 a tonne. And the pricing pressures in the market at the moment and forecast in the future are actually expected to get tighter. We've got binding offtake in place alongside a big equity contribution from the world's largest lithium producer, Ganfeng. alongside our long-standing binding offtake agreement with Yahua, who are likely to link us into being part of Tesla's supply chain. So we're ready to build stage 1 of the project, but we'll shortly be also investing into stage 2 and stage 3 of the projects to expand production and to look further into downstream manufacturing, into chemical manufacturing in the future as well. Next slide, please. So our project is fully funded. It's ready to build. We're looking to achieve FID over coming months and start construction of the project before the end of this year. We've just completed a $91 million institutional placement that was hugely oversubscribed at 31 cents. We're just about to wrap up a $15 million share purchase plan from shareholders that's been well applied for. And importantly, we've just completed an additional binding offtake agreement with Ganfeng, who are contributing a $34 million equity investment, which was actually at a premium price at close to 34 cents. So we're fully funded. Project's ready to build. Next slide, please. And we've got offtake with some of the key players in the lithium battery supply chain. Ganfeng, it's a 4-year offtake deal. They're providing $34 million of equity. Alongside that, we've got an offtake deal with Yahua. And earlier this year, Yahua signed up a supply agreement with Tesla. So it's very likely once we get into supply, we're supplying Yahua with lithium concentrate. They are going to be converting that to lithium hydroxide, and they're selling that lithium hydroxide to Tesla. So we're very likely to become part of Tesla's supply chain, and we're becoming part of Ganfeng's supply chain. So we're tied to some of the biggest names in the EV space and the lithium battery supply chain. Thank you. We think there's an excellent opportunity for investors and shareholders in the company as we move towards production over the next 12 months, and we get valued alongside the existing Australian lithium producers. With a merger now of Galaxy and Orocobre, there is now no lithium producer on the ASX that's valued at less than $5 billion. Okay, so as we move into production over the next 12 months, we will move from being priced as a developer. And let's put this in context. It's a project that's fully financed, it's construction ready, it's low risk, and it's ready to build. So in the next 12 months, as we move into production, we'll be valued as a producer. And currently across the globe, lithium producers are being valued at about 20 to 20 times EBITDA. We're looking to and through our DFS, you can see our EBITDAs. You can look through those at a very conservative price of $750 US ton. Our annual EBITDA is about 75 million. If you plug in today's prices and future prices into that, that's a significantly higher number. So as we move towards production, we will be likely to be priced as a producer. And as I said, currently global lithium producers are being priced at about 20 to 25 times EBITDA. Thank you. So we are delivering on stage 1 of the project right now. So we will start construction of the finished lithium mine and the processing facility this year, and be in production on stage 1 by the end of next year. Alongside that, producing in the order of 175,000 tonnes per annum of high quality lithium concentrate, SE6. Stage 2 of the project is the company targeting to significantly increase production towards 2024. We're currently investing into additional resource growth. We've got a $10 million budget that we're, for this financial year, that we're putting into exploration and resource drilling. On the back of the recent financing, we're looking to double that investment in growing resources and mine life for the project, which will lay the foundation for us to significantly expand production from the project, so expand SC6 production. And for example, if you look at our CapEx to process plant CapEx to produce 175,000 tonnes per annum is only about $40 million Australian. So if we replicate that again for stage 2, for an additional $40 million CapEx, which would likely come out of cash flows in 2024, we would then be looking at a project that has the capacity to potentially produce 350,000 tonnes per annum of concentrate. So that's a real opportunity for us at stage 2, is to potentially substantially increase concentrate production. And that's not just about leveraging the value of that asset for the company and its shareholders, but really it's a response to the demands and the expressions of interest that we've had from the lithium battery supply chain and from our customers and future customers that are saying, build more production, build more capacity. We want to take more product from you, and we want to take it for longer. And then stage 3 for the project is really about the company moving towards and potentially moving towards lithium hydroxide, so lithium chemical manufacturing from the Middle Arm industrial site adjacent to the mine and to the city of Darwin, halfway between mine and port. We've got strong Northern Territory government support for that. And indeed, we've actually received $6 million of Australian federal government support for us to undertake feasibility studies to bring forward that investment into stage 3, into lithium chemical manufacturing. Thank you. And we really think, stage 1 of the project, which we're looking to start construction on in the next few months, is just the beginning. We put together an acquisition deal earlier this year. We've got 3 drill rigs on site right now, drilling exploration and resource expansion holes, with the aim that we're looking to more than double our life of mine and double the resources of the project over the next 15 months. We've got a level of confidence in achieving that goal, in that we've already defined an exploration target of between 10 and 16 million tonnes, and we're now drilling that and undertaking additional exploration. So, we think there's a strong pathway for us to continue to grow the resources and the life of mine of the project. Thank you. I'll move to the next slide. Thank you. Key attribute of the project is its low capital intensity. It's a low risk project. It's one of the world's most capital efficient mining projects, and you compared to those projects around the globe. Thank you. And importantly, the project is close to Darwin Port and the capital city infrastructure. So there's a whole bunch of infrastructure we get to leverage: access to the port, plugging into grid power, our workforce based in the suburbs of Darwin, access to an international airport. So that's a whole bunch of CapEx that we don't need to spend, that gives us access. So that's one of the real key strengths of the project, alongside the excellent grade and resource quality. Thank you. And just finally, I mentioned earlier, we've recently received a $6 million Australian federal government grant for us to undertake feasibilities to produce battery-grade lithium hydroxide from the project. So we're undertaking a scoping study at the moment that we should look to release to the market shortly, which has excellent economics, and puts us in a great position to actually extract value and really leverage the value of this excellent quality asset. Thank you. And final slide, we've completed our DFS, we've completed offtake and financing. We're looking to complete FID on the project over coming months and start construction of stage 1 by the end of this year, which will put us in a position where we're starting production by the end of 2022, right at the front of the line of new global lithium production. And then we're also investing in laying the platform and the foundation for stage 2 to expand concentrate production in the future, and investing in the feasibility to produce lithium hydroxide, lithium chemical from the project through stage 3 from the project over time. Thanks for your attention. Appreciate your interest, and thanks for shareholders and investors in the project over time. Appreciate their support.
Well, thank you for the presentation, Stephen. We'd have a few questions come through, so I'll jump into it. So can you please elaborate on the company's drilling plan for next year?
Yeah, sure. So we're actively exploring and resource drilling currently. So we've got roughly a 10 million budget that we're investing right now into resource growth. That's for this financial year, and probably a budget very similar, sort of doubling that scale sort of over the coming period as well. So, we're really investing. We think the project should be, the DFS we've released to date, it should be just viewed as a snapshot. That the project will continue to expand.
Perfect. And just another one. So some other companies have had success with spot selling options. Will CXO be considering this?
Yeah, well, the terrific thing about our offtakes, we've got offtake with, some of the best names in the lithium battery supply chain, but we also have spare production that we can push into the spot market. So, we're really looking forward to getting into production by the end of next year and getting some product into the market, right at the right time with excellent pricing and being exposed to spot pricing.
Perfect. Well, thank you for joining us, Stephen. A copy of today's presentation will be available online on brokerbriefing.com in the coming days. Thanks again.
Great. Thank you.
The next presentation is from Infiniti Lithium with the ticker code INF, a company focused on the development of its flagship lithium project in Spain. To tell us more, I will now hand you over to our Investor Relations Manager, Lucas Robertson. Good morning.
Hi there, Jane. Thanks very much for having us on. Very pleased to be part of Broker Briefing.
Wonderful. I'll just share your presentation.
Thank you. That's great. We just go to the corporate slide, please. Thanks a lot. Infiniti Lithium is a lithium-focused company listed on the ASX. The company's key asset, flagship asset, is the San Jose Valdeflores project in the Extremadura region of Spain. As you can see from the corporate information there are around 400 million shares on issue, which at the prevailing share price gives rise to a market cap of around $37 million. As of June 30, there was around $19 million in cash in the bank. So the enterprise value is sort of under $30 million, which we think compares favourably on a value basis to our peers. On the left, you've got the board of directors. Ryan Parkin is the CEO and managing director of the company. He's a chartered accountant by training with a strong corporate background and has been in the MD role for about 3 years, appointed in August 2018. The other two executive directors on the board, John Starink is a global lithium expert with extensive downstream chemical conversion background and experience. Remy Welshinger, who is London-based, has had investment banking background. And the non-executive chairman is Mr. Adrian Bias, who shares his role on the Infiniti board with a number of other ASX-listed boards and has been involved in this company in one way or another since 2011. The company secretary is Jonathan White. I'm helping the company with investor relations. I had a long experience in stockbroking and currently run an investor relations consultancy called Corporate Storytime. Next slide, please, Jane. So the San Jose Lithium project, Infiniti owns 75% of this project with an option to go to 100%. It is Europe's second largest hard rock lithium resource. The plan is to build a chemical conversion facility next to the San Jose ore body to produce 15,000 tonnes per annum of lithium hydroxide over a 30-year project life, of which 19 years will be involved in mining and a substantial period of the project will simply be a chemical conversion project. a PFS that was conducted about 2 years ago came up with an NPV of around $860 million US. Next slide, please. So from an ESG perspective, it's important that people understand that this is more than a mining project. Infiniti will produce value-added downstream battery lithium chemicals. From a local community perspective, we plan to bring substantial prosperity and employment to an economically challenged region in Western Europe, and hope to build, long-term skills and training within the community. The project will provide materials for the battery and EV market within Europe, and by doing this will allow EVs and batteries to be produced with the lowest possible carbon footprint. The project is aligned to the EU plans for battery passports to produce sustainably sourced products that can speak to their sustainability and green credentials and are ethically sourced. Next slide, please. So I suppose my background as a stockbroker, I always based my investment philosophies on broad social and macroeconomic themes, and then sort of trickled down from there. It's pretty clear that the 2050 net carbon zero agenda is going to be a theme that plays out over this decade and several decades to come. E-mobility is going to be an enormous part of that. The huge expansions that are already underway in the European battery and electric vehicle production, as you can see from the map on the left, that speak to that. And the European automakers want European EV materials. The battery passport plans from the EU that I spoke about mean that these production facilities are going to have to ensure that the materials are sourced responsibly. And to this end, the current sort of reliance on Chinese battery material chemicals for this market is simply not sustainable. A lot of the Chinese chemicals are fed by ore sources from as far away as Australia and South America, and they leave a substantial carbon footprint by the time they've actually arrived to be manufactured in Europe. Within Europe more broadly, there is a substantial amount of cheap government-sponsored debt funding available for projects like this, which plays into, we think plays into Infiniti's hands to get this project funded. Next slide, please. So this is, as Stephen's mentioned in the previous presentation, this isn't something that's a theoretical market dynamic down the track. It's here and now. From a broad sort of global demand and global price point of view, there's been a substantial increase in demand for lithium products this year. JP Morgan, the global investment bank's talking about 19% compound increases per year for the next 10 years. And we believe that the EU is at the heart of this demand, and that the EU policymakers and industry are driving this harder than anyone. The quote at the bottom in relation to 1,000 gigawatt hours of lithium-ion battery production capacity planned within Europe by 2030, that number is roughly twice what was estimated for the 2030 capacity only 12 months ago. Next slide, please. So to this end, automakers and battery producers need to lock up their supply chains. Infiniti has an MOU with LG Energy Solution. LG is the world's largest battery manufacturer. That is to provide 10,000 tonnes of lithium hydroxide to LG for up to 10 years. I suppose closer to home in Australia, there's been Tesla locking up supply of nickel with BHP Nickel West, And these sort of transactions and these sort of links for supply chain security are going on all over the world. And I suppose we'd point out that the auto industry in Europe is extremely large, but the opportunities for them to align with European projects such as San Jose are not so plentiful. Next slide, please. So the auto industry in Spain is already very important to the economy. They're the second largest European auto industry. There are 2 million jobs associated with the industry in Spain, and it represents a very large 10% of Spain's entire GDP. Nevertheless, the focus towards an e-mobility future sees the Spanish government indicating a desire to get to 15% of Spain's GDP.
Lucas, are you still there? I think we might have actually lost Lucas. Let me just... Sorry, you're back. Yeah, you're back.
Yeah.
Sorry, you cut out for a little bit there.
Oh, okay.
I'll let you jump back.
Okay. I'm not sure how far I got through. Perhaps I'll just go to the next slide. Thanks, Joan. Thank you. So to this end, the importance of the Spanish auto industry is underpinned by the PERTE initiative, which was announced by the Spanish government in July, whereby the Spanish government will invest 4.3 billion euro over the course of the next 2 years to kickstart the production of electric vehicles and batteries in Spain. And the Prime Minister of Spain, Pedro Sanchez, has mentioned that this should include the extraction of raw materials in the overall supply chain, such as lithium. So it's clearly something that the government's well focused on. More broadly speaking, the EU has seeded the Coronavirus Recovery Fund. That is a 750 billion euro fund, of which Spain's share has been allocated to be 140 billion euro. So it probably doesn't sound like much when you say it quickly, but it's a staggering amount of money. And to that end, it's been allocated to help the continent recover from the coronavirus pandemic. Infiniti has aligned themselves with BatChain, which is a consortium of e-mobility related Spanish companies applying for $1.2 billion of those funds. Next slide, please, Jane. Thank you. So current activity for Infiniti to build San Jose into an essential supplier of battery chemicals into Europe, to advance permitting, and there has been some challenges recently at a provincial level with permitting, but nevertheless, the company is going to proceed, plans to proceed to lodge mining environmental applications next year, to build out technical and commercial capabilities, most particularly with our technical partner in Germany, Dorfner Anzaplan, and also advancing the MOU with LG to a more binding sort of contractual level, and to advance further discussions with key industry players within Europe, and particularly automakers and battery producers as well. Next slide, please. Thank you. So this is the last slide. Infiniti Lithium will be a vertically integrated producer of high value battery chemicals. We will provide economic lifeblood to a region that really needs it and provide jobs for the long term. It's all being driven by a desire to achieve net zero carbon by 2050, which is particularly strong within Europe. And that is resulting in a really critical uptake in electric vehicles, with registrations of EVs well outstripping those of diesel vehicles in Europe now. The real takeaway is that the move towards EVs in Europe is progressing rapidly, and the supply chain for battery materials needs to remain close to these production centres. So we see San Jose as being a really vital player in this general thematic. So that's it. Thanks very much for the opportunity to present, Jane. And if you've got any questions, please fire away.
Lucas, that was a great presentation. We do have a few that have come through, so I'll jump into it. So with the project having strong ESG credentials, do you think that sustainable lithium will demand a higher price in the market, or will sustainable lithium become a requirement for offtake partners?
I think it's more likely to become a requirement. I think that the battery passport plans that are in place and are sort of on the way to being mandated by the EU will see that is just going to be a minimum requirement, that these materials that go into the sort of batteries and EVs of the future will need to come from sustainable ethical sources.
And just back to the project now. So how long do you anticipate it will take from the start of development to the production phase?
It's probably around 2 years. So that's from the findings of the PFS that was delivered a couple of years ago now. The company's in the process of developing a definitive feasibility study for release sometime next year to confirm all of that.
Wonderful. Well, thank you for joining us, Lucas. And of course, a copy of today's presentation will be available on brokerbriefing.com in the coming days.
Thanks for having us.
So lastly, we have a presentation from upcoming IPO McArthur Oil and Gas. McArthur Oil and Gas is a company focused on the exploration and development of its Australian oil and gas projects. To tell us more, we are joined by Executive Director Brad Lingo. Hello, Brad.
Hello, Jane. Thank you very much for giving us the opportunity to present McArthur's story.
No problem. Let me pull up your presentation.
Thank you, Jane. McArthur Oil and Gas is an IPO and demerger of the existing Northern Territory, Northern Basin assets of Armor Energy. Next page, please. The McArthur corporate snapshot. McArthur has a commanding position in the McArthur-Beetaloo basins, which is a primary location of the Commonwealth government's focus on the gas-led recovery. We have the largest contiguous acreage position in the McArthur-Beetaloo, covering over 96,000 square kilometers, with an NT-focused experienced board and management team. Very large exploration potential, with over 4.6 TCF of conventional resources and over 28 TCF of unconventional resources. What's unique about McArthur is that we do have multiple proven plays, both conventional and unconventional, providing a world-class opportunities. We already have existing discoveries of low CO2 conventional gas in a proven Coxco dolomite play fairway, which is unique to the McArthur position. That provides the company with an early mover development potential of conventional gas discoveries supplying into existing local gas markets right within our acreage in the Northern Territory. We have very low drilling and development costs at circa $3 to $6 million per conventional well. And we are positioned to be a fast follower in the unconventional. And we believe that this all coming together provides a very compelling valuation on a prospective resource on a terajoule per market cap basis for the proposed IPO. Next slide, please. So our strategic vision is really based on three horizons: to be a conventional leader, leveraging off of our existing conventional assets and conventional discoveries with early production and sales, establishing a market presence into a high premium price energy market, and to be in Horizon 2, to be a fast follower with our unconventional resource potential, and to leverage both of those together with exploration and development success to be a large-scale producer of both unconventional and conventional natural gas resources. Next slide, please. So Macarthur is also unique in, I guess, our focus, vision, and values. When looking back at the last 10 years worth of history in terms of oil and gas exploration and development in the Northern Territory, we would see that the primary risk has been not the ability to find hydrocarbons. The hydrocarbons are being discovered, they are being appraised, and now they're ready for development. The biggest risk has been that social license to operate. And so our focus as Macarthur is to be focused on proving up the commercial potential of the greater Macarthur and Beetaloo basins, both conventional and unconventional, and to become the Northern Territory's leading gas explorer and producer. And we see delivering that through our value proposition of respecting the people and environment in which we operate, delivering what we promise, and integrity in everything in what we do, and a commitment to quality and execution, and establishing and maintaining quality relationships with all of our local stakeholders. Next slide, please. So our distinctive position is that we do hold these material interests across multiple proven and prospective basins. Our acreage covers a significant conventional and unconventional play fairways with pervasive, thick multi-TCF unconventional shale gas sequences with potential for stacked conventional and unconventional pay. But uniquely, we hold exclusively within our acreage the proven Coxco conventional play fairway in the Glide subbasin, where we've already demonstrated exploration success. Next slide, please. We have put together a board that really speaks to the quality of the asset proposition and the demerger and IPO that we're putting forward. Unique to Macarthur is that across our board and our management team, we have been involved in every single bit of acreage in the Macarthur Beetaloo, either technically or commercially over the last 10 years. Our independent chair, Greg Martin, has come on board, has a long history with the Northern Territory, following in his role at AGL, and as the chairman of the NTKS pipeline. Jeff Barker, our non-executive director, is one of Australia's leading unconventional resource experts and recent executive general manager at BPH Energy in charge of development. We have two Northern Territory-based directors, Karen Green and Ray Hall. As I mentioned before, we're first and foremost on maintaining our relationships and delivering what we promise within the territory. And we think having directors on the ground will keep us very, very oriented and have a finger on the pulse of exactly what we need to be doing to deliver that mandate, deliver our activities in the Northern Territory. Next slide, please. In terms of our proposed management team, Andrew Logan, Jeff Hoken, from an exploration and resource perspective, have been at the coalface, so to speak, on the Macarthur Beetaloo for the last 10 years. They have been in all of the acreage, both from a technical perspective and new venture development perspective that sits within the Macarthur portfolio, within the Empire portfolio, with the Tambridge portfolio, and with the Origin and Falcon portfolio. David Spring, very experienced chief operating officer. And to complement that team, we're very close to announcing the appointment of our full-time permanent CEO, who is one of Australia's leading explorationists. Next slide, please. Again, as I've highlighted, that commitment to that social license to operate is first and foremost, and we've embedded that all the way at our board level with the establishment of a risk and ESG subcommittee to make sure we keep that first and foremost on our mind, with a focus on sustainable development and carbon management all the way through our exploration and development process. Next slide, please. And we do have those established relationships. This acreage has been core within the Armor Energy portfolio since 2012, and we've maintained those relationships, which McArthur will inherit. That will allow us to deliver the work programs that we are outlined in this presentation and move through the exploration phase and move through the development phase on our existing discoveries. Next slide, please. We have independently certified prospective and contingent resources by Nether and Sewell and Associates, the global leader in independent certification of petroleum resources. NSAI also provides the same independent estimates for peer companies, so they're very familiar with the resource plays across the McArthur Beetaloo. Next slide, please. So I've talked about this overlaying footprint of our conventional and unconventional plays in the stacked play fairways. We have the Coxco and Reward Dolomites, where we have existing discoveries that sit immediately adjacent to and uniquely adjacent to the existing markets and pipeline infrastructure in the McArthur Beetaloo, and which is unique to the McArthur acreage. Overlaying and interbedded within that conventional play is the proven Barney Creek Shale, the very first unconventional shale gas play to be drilled and flared gas to surface in the McArthur Beetaloo. Next slide, please. So our conventional targets, there's this very well-developed play fairway along the Emu Fault Zone, where we have multiple discoveries and multiple undrilled prospects. It is a prolific fairway, and it was first recognized through mineral core drilling by Emeco all the way back in 1979. Next slide, please. When we zoom in, you can see the proximity of our discoveries to Glencore's McArthur River Mine, where we have our Glide gas discovery, where we have pending applications for retention licenses, is part of the next stage toward developing that discovery. We have existing discoveries at Glide, Cal Lagoon, and Lamont Pass. We have over 60 undrilled prospects and leads within this fairway at very shallow depths with a prospective resource potential of 2.6 TCF, which is a very big number in the gas game. Next slide, please. In terms of those unconventional plays, you can see on this stratigraphic column that the Barney Creek Formation, we actually have to drill, that is our principal unconventional initial play. We have to drill through that to get to the Coxco. So we have a significant opportunity to delineate, explore that while we're targeting our primary conventional objectives in the Coxco. So that source rock sits immediately adjacent to our conventional plays. It is a shale that is directly analogous to the prolific Utica shale gas play in the northeastern part of the United States. Next slide, please. Looking at that gas, the Glide gas discovery, I mentioned the Emeco 1979 core hole, the Glide River 9 mineral core hole. Much to their surprise, they were drilling for copper zinc occurrences along that Emu Fault Zone, and they made a gas discovery. It was such a good gas discovery that it flowed at 6 million a day of unconstrained gas flow, and flowed at that rate for over 6 months before Emeco could come back in with the appropriate equipment to plug and abandon that well. In 2012, Armour came back and re-drilled that accumulation and reconfirmed the discovery and flow tested that well at 3.3 million a day, which is quite a healthy gas flow rate. What more importantly, it flowed near sales quality gas with negligible CO2 and the potential for hydrocarbon liquids to add to the economics. Next slide, please. We have a fast-track commercialization plan for the Coxco play fairway and the Glide gas discovery using a virtual pipeline solution with skid-mounted and modularized LNG and CNG production facilities that we can put directly in the field and to truck that gas out directly into the pipeline infrastructure and directly to the McArthur River mine, which is quite a significant market in terms of both volume and revenue potential. Next slide, please. Our proposed work program is very much focused on delineating that play fairway post the completion of the demerger and IPO. Move to the next slide and we'll talk about the work program in Gantt chart view. You can see it's quite a robust program, all focused on delivering first extended gas production in middle of 2022 with a view of achieving first commercial gas sales from the successful appraisal of that existing Glide gas discovery by early to mid 2023 when the Glencore McArthur River mine gas contract is up for renewal. We will have quite an active drilling and seismic program, and we've already started the regulatory process to execute that program starting post the IPO demerger. Next slide, please. So what are we aiming to deliver out of the work program? To prove up the overall extent of the Glide gas discovery, but converting contingent and prospective resources to reserves, to mature that to production and establish its commerciality for development with a view of having commercial gas production in early to mid 2023. On the conventional exploration side, we want to prove up the gas resource potential at the Cow Lagoon, Kilgore North, and at one additional Coxco Dolomite prospect, and mature the prospective resources to contingent. We've acquired a very significant, it's actually the largest privately acquired airborne survey in the Northern Territory. And we're going to be using that data when we receive it next month to refine the leads and prospect inventory to define the next batch of exploration activities, both seismic and drilling, and to follow up as a fast follower in the unconventional exploration by appraising and testing those stacked shale plays associated with the conventional drilling program, and also to test the deeper shales as we deepen the Cow Lagoon and Kilgore North wells. Next slide, please. So how do we compare to our peers? We think we compare quite favorably. We've got the largest contiguous acreage holding, second largest acreage holding in the entire McArthur Beetaloo. On a prospective resource basis, very comparable to that of both our peer empires and Tamarind Resources, which recently IPO'd. Where we think we have the real advantage is the comparative well cost, because we can focus on the conventional. And then when we really show that strength of comparison, it focuses on those demonstrated flow rates that we've been able to deliver. So we're getting much more gas per well at a lower cost with a much higher flow rate. And when we look at the implied in-ground value, next slide, please, on our proposed IPO capital structure, we will be the true value proposition. We'll have the lowest well costs, we've had the highest flow rates, and we're putting a value proposition to the market that We are leaving significant opportunity for capital appreciation for investors in Macarthur post-IPO. Next slide, please. So our investment highlights. We have that commanding acreage position. The NT Minister has approved the transfer of the permits out of Armour into Macarthur. We have that established social license to operate. We uniquely hold the proven Coxco play fairway with sales quality gas and liquids, offering us the potential of offering an early mover advantage in commercialization. Equally, we have the exploration of an unconventional plays as a fast follower based on the activity around us. We have a large independently certified prospective gas resources. Our retention license applications provide us that potential for first gas to market in early to mid 2023. We have clearly identified markets with a priority on the Northern Territory first as part of our overall support from the government to drive and maintain our social license to operate. We're utilizing an early production system to deliver that early commercialization through a virtual pipeline through the use of skid-mounted CNG and LNG technology. We have a board that is very focused on and committed to ESG to maintain that social license to operate. And it is an experienced board and management team with significant industry, financial, and technical, geological, environmental experience, absolutely critical to deliver this program. Next slide, please. So our cautionary statement. We do have, in advance of the IPO and demerger, there is a pre-IPO investment opportunity. And if you're interested, you can contact Michael Pegum or Ben Callanan at JB Advisory through Jane Morgan Management to find more about that opportunity. Thank you very much.
Cool. Thank you, Brad. Thanks for the great presentation. And yes, if anyone is interested, please feel free to reach out info@brokerbriefing.com. We've got a few questions for you though. So
yes.
What, I know you did touch on this in the presentation, but what news flow can be expected following the IPO? And can you please elaborate on the IPO timeline?
Well, the first, we've been relatively active in terms of news flow over the last 4 weeks because we've kicked a number of major goals. First, getting the ministerial approval to transfer the licenses to Macarthur. The fact that we'll have a news flow coming out about the renewal of the license for an additional 5-year term with no acreage relinquishment, which is quite a good. We've been able to deliver initial approvals that will be able to execute the demerger on a tax-effective basis. On a go-forward basis, we've announced the board and the main construction of the management team, but I think the next big announcement will be the appointment of our full-time CEO, who's going to be the driving force behind Macarthur and its exploration program. In terms of additional news flow, it's the completion of the pre-IPO funding and then moving into delivering a Pathfinder prospectus that we can share with prospective investors as we also move to the appointment of JLM to take the IPO forward.
Well, Brad, exciting times. I'm looking forward to being involved and seeing what we've got coming up.
All right. Thank you very much, Jane. It's our pleasure.
Thanks so much. And thank you all for joining us today for Broker Briefing's investor webinar. Recordings of all today's presentations will be available online in the coming days. We look forward to hosting you again soon.